Assalamu alaikum and welcome to the new series, the Oasis Focus on Finance show. I'm your host, Shafiq Morton. We'll be with you every single week and we'll be looking at and understanding the world of finance and investment. Should you want to contact us, our SMS line and email address will be on screen during the show. If there is anything you'd like us to discuss, please send us your questions and suggestions. Tonight I'm joined by Daniel King and Fahad Sheikh, investment analysts at Oasis. Gentlemen, good evening. Assalamu alaikum.
Wa alaikum salam, Shafiq.
During Ramadan, we spoke about the local and the international economy. Now things do change, the markets are fluid and they have changed. And recently there have been some developments. And this evening, gentlemen, we're going to be looking at current trends. Fahad, let's have a look at what's known as the Greek crisis. How do we understand the dynamics of what's happened in Greece?
I think the basic problem in Greece has been one of where you're spending more than what you're earning. In this case, basically, the Greek government was spending a lot more on current spending than what they were actually collecting in taxes. And there were issues around non-compliance in terms of tax collection. So if you look at it, throughout the 80s, 90s, and even the 2000s, their budget deficit was running at almost 5% of GDP, all the way leading up to the financial crisis in 2008. So throughout that time, your debt to GDP levels or your government debt was continuing to pile up. Then in 2008, when we entered the financial crisis, as a response to that, we know a lot of European countries, including Greece, they stepped up expenditure even more to prop up their economies without doing anything about the revenue side. So that just made matters worse. And now, just to give you the extent of it, if you go back to 1990, Greece's debt as a percentage of GDP was only 68% compared to 180% right now.
And I think just to add to that, a lot of that increase towards the 180% of GDP that we see now, Greek government debt, has been in the last 3 years. And that's despite some of the deepest austerity measures that we've seen in Greece's history. And you'll notice from the more recent negotiations that they're required even further spending cuts, tax increases. But we think that the jury is still out on whether that's an effective way of reducing the government's debt burden. It's quite well established that for every €1 in government spending cuts, your economy actually shrinks by more than €1. Because it's not only the government spending that declines by €1, but it's also the people that would have received that money that have to that face a decline in their own income. Having said that, there have been some successes with austerity in Europe in the past. We know Ireland is a good example of that. They've weaned themselves off financial support. Spain is a really good example. Currently, they're growing at very robust rates relative to the rest of Europe. And to some extent, Greece has also made some progress in terms of competitiveness through what we call internal devaluation. So the competitiveness of their labor market has improved significantly over the last 3 years. Their unit labor costs, which is a measure of that competitiveness, has declined or improved by the most of any country in Europe over that period. So it is possible to grow yourself out of the problem over time.
Now, some analysts are saying that there could be a comparison between Greece and South Africa, or there's a potential to this comparison. I think the question we have to ask, is this a fair kind of thing to say?
I think South Africa's fiscal challenges are reasonably well documented. So we do face some imbalances in terms of the mismatch between government spending and government revenue. But I don't think it's fair to put South Africa in the same category as Greece, or even anywhere near the same category as Greece. You know, South Africa ran budget deficits over the last 20 years in the order of about 1% of GDP. So that's the extent of the mismatch. Whereas Greece ran budget deficits in the order of 5% of GDP. 5 times higher. South Africa's government debt to GDP at the moment is only about 45%. Greece's government debt, as we've pointed out, is between 180% and 190% of GDP. So we're not even in the same vicinity. But having said that, we shouldn't become complacent. Debt dynamics can get out of hand relatively quickly. We can take some comfort from the fact that the South African government has been proactive to an extent by starting to slow down increases in expenditure and kind of raise revenues in the last few budget statements. But it's important that they support that with meaningful private sector reform that stimulates business confidence and investment if we're going to avoid the kind of debt trap that Greece finds itself in.
Gentlemen, we've also been hearing stories about China, and I think the question we have to ask here, what sort of a risk would China pose to us? What sort of a risk would China pose to the world market?
I think China is going through an unprecedented change at this point in time in terms of just the scale of change that's going on there. If you look at the last decade almost, the growth in China has been driven by infrastructure spending. They've been spending a lot in terms of their roads, a lot in terms of the buildings, housing, and that's basically what's driven the strong growth, above 7% growth that we've seen over the last decade. Now that model is changing. China is trying to move that growth away from infrastructure and investment towards consumer spending and services. And we've seen to some extent that's starting to come through. For example, if you look at the financial services sector in China, that's growing a lot faster than what overall GDP is growing. If you look at the overall services sector in China, just in 1999, it used to make up 30% of GDP compared to almost 50% of GDP currently. So we're seeing that transition coming through slowly.
But I think importantly to add to that, although we have seen some success in terms of moving towards a service-oriented, consumption-oriented economy in China, the stimulation of a consumption culture, I think, has been slower than what Chinese policymakers have been targeting. And part of the reason for that is that Chinese households are very reluctant to spend all of their income. They're actually very active savers because of things like a lack of a social safety net to the same extent that you see in other advanced economies and even some emerging economies. Contrasting that, we've actually seen quite a lot of success in their slowdown in inefficient investment expenditure. So when you net out those two effects, you've got a slowdown in aggregate growth. And I think the miscalculation of the slowdown in investment expenditure and a failure to meet their targets in terms of stimulating consumption presents one of the biggest risks in China at the moment.
Something else that's come out is that the Chinese market has been extremely volatile. I mean, we've seen shifts of like 8% in a matter of a week or so. How do we understand this? I mean, how frightened should we be about this, and how do you deal with this in terms of investment?
I think as part of the Chinese government's attempts to stimulate that kind of consumption culture, reduce savings rate, they've allowed their stock market to increase at a very rapid rate over the last year to kind of stimulate what we call the wealth effect, meaning that people start to feel wealthier, they start to consume more, they start to save less. And in this drive to get the equity market propped up, to get it to start rallying to a very meaningful degree over the last year, they've allowed households to start borrowing money for the purposes of speculating on the equity market, on the stock market. But what this does over time is that it starts to exaggerate stock market volatility. So this borrowing for the sake of stock market speculation has increased from virtually zero in 2012 to over 2 trillion won in June this year. And what this means is that when people use borrowed money to speculate on the stock market, even a small negative shock can cause the lenders to become nervous, start calling in some of their loans, and that forces households to sell the equity, the stock that they've bought in order to raise the cash to repay those loans. So you get a self-reinforcing cycle which exaggerates the volatility of the market in that way.
And I think at the same time, it's that volatility, but also the nervousness around China slowing down from that 7% that it was growing at. Because this transition from investment to consumption is unlikely to be very smooth. So we have seen GDP growth come back a bit, and I think that's also causing a lot of volatility and nervousness in the market. I mean, to some extent, we've seen the Chinese government take some very extensive measures to reduce that volatility, to the extent that I think they freezed almost 45% of the equity market for a period of time just to contain that volatility. But I think the important thing to realize from how we're investing or how we're managing our clients' money is that you can get exposure to that strong growth in China without actually investing in China. The way we do that is that we invest in companies which are regulated and listed in the developed part of the world. So you get better regulation, better corporate governance, but then those companies are getting more than 50% of their earnings from places like China and other emerging markets. So you get a very good balance where you're well regulated and still our clients get exposure to the growth the higher growth that's coming through in places like China.
You are watching the Oasis Focus on Finance show. Our guests are Daniel King and Fahad Sheikh, Oasis investment analysts. We've been discussing local and international markets, the effects and current trends. We'll be back right after this.